Hey everyone, so just a quick one on the UK budget 2024. So many of you might be wondering, will you be better off or not, based on maybe primarily the national insurance cuts. So it's not as simple as you think. So I suppose the numbers that they quote are for the typical person in the UK earning, I think it's 35,000 a year. So obviously that's going to be pulled up by very high paid jobs in, say, London, what have you, and then it's going to be pulled down by, a lot of the low paid jobs or part-time work, etc. So that might be the average, but for example, if you're on minimum wage, last year you would have been on just over 21,600 a year at minimum wage, 40 hours a week, and you would have paid just over £1,800 in tax. Okay, so say if you are still on minimum wage, but as of April you're going to be going up to the national living wage, which is going to be £11.44. Then, if again you still do 40 hours a week, work full time, in a year you'll be on 23,795 and 20 pence. Okay, so you think, oh great, you're better off. So in terms of tax, your tax is going to go up from just over £1,800 to just under £2,250. So you're going to be paying £425 in tax more, basically. So when you hear these headline figures of average person will save £450, a year, and then obviously they've done basically that reduction twice, so you'd think, oh great, I'm going to be £900 better off. Unfortunately, that's not going to be the case for a lot of people, because yes, obviously you're earning more, but because they've kept the tax-free allowance the same rather than it going up with inflation or going up by an arbitrary amount, basically you're paying 20% tax on all of your increase, which means basically you're going to be paying £424 more in tax in 2024, the financial year, rather than 2023 financial year, even if you're just on minimum wage. So so it's just something to think about. And obviously those headline figures, which obviously in theory would be since 2024 start of the year, you'd think you'd be £900 better off. But actually, for someone who is on minimum wage, we'll use the 2024 minimum wage that'll be effect from April. Initially you're losing that £425 basically in tax, and then what are you better off? By these national insurance reductions, it's £448. So you're really, it's only about £23 better off you'll be. So 50p a week, and there's also all the connotations. What's that going to do to public services, and things like that. So yes, it's not as good as it sounds when you hear these headline figures, and yes, they disproportionately help higher earners. So if you're liking the content, please like and subscribe. Another interesting point that they had kind of mentioned previously, but mentioned again, is the British ISA. So I think the thinking of this is they would keep the current allowance of £20,000, which obviously could be in either a mix of all the different types of ISAs or all in one of them, whatever you prefer. I suppose cash ISAs, lifetime ISAs, stocks and shares ISAs, and so on. So the idea with the British ISA is that it would be an additional allowance of £5,000 per financial year, where you could pay into what sounds like one, although this is part of the consultation, sounds like you'd be able to pay into one of these British ISAs, and then that would mean that you'd be putting money into potentially a company on, say, the FTSE 100 that is listed in the UK. So that's the idea with that. I suppose it may work, but the companies may not make much of, may not make all of their money in the UK or hold all of their assets in the UK or anything like that. It could be, that they make 20% of their money in the UK. So although the funding will go to companies that are maybe based in the UK or listed in the UK, it doesn't necessarily mean it's or kind of investments for UK companies that would 100% be used in the UK, I suppose. So yeah, what you make of that, but it could be a good way to make some more investments, although also I'm aware that a lot of people aren't in the position where they're maxing out their £20,000 ISA allowance anyway, so that may not help. Obviously, the non-dom status changes, may not make any particular difference to a lot of you listening. Whereas the NI contributions, obviously, particularly for people who are working, that will maybe make a difference, but it will be more likely to make a difference if you're, say, in the 30 to 50,000 bracket, because you're not yet paying a high rate, income tax. But then, because it's basically percentage based, you'll be saving more in NI contributions than someone on, say, 20,000 a year. So, yeah. So hopefully that kind of helps explain. And just with the income and NI thresholds, the point at which you start paying tax being frozen. Yes, it's a bit of a double-edged sword when it comes to the tax cuts, because on the lower incomes you will not be particularly better off. On the higher ones you may be, they give some examples on the Gov website. If you're on something like 60,000 a year, you're going to be a few hundred better off potentially. So if that's a family, you could maybe double that. But for a lot of lower income earners, it's the tax increase or the effective tax increase with the static limits for tax-free allowance, which haven't really changed since 2021, and I think even that year they only went up a tiny amount, like £70. Most people, they're not going to be particularly better off if you're, say, under £25,000. Even for a family of two, it's not going to be. It's only going to add up to something like £1 a week that you'll be better off. By the time you've paid more tax, but paid less national insurance, you're not going to be much better off. Okay, so a bit more detail on how the government's planning to balance some of the tax loopholes, I suppose. So with the non-dom status, at the moment, people don't really pay any tax in the UK on earnings that they've earned overseas, as long as they don't pay into UK bank account, and as long as their permanent country of residence is listed as a different country, not the UK. So this will change as of April 2025, and I think this is planned to kind of raise a few billion. So yeah, it's probably a good change, but there's still a 4-year window where people wouldn't need to pay that. Whereas I suppose maybe the thinking is, if someone resides more than 4 years here, then kind of it is becoming their permanent residence, even if on paper their permanent residence is a country that has maybe lower tax. So that should that should balance out the taxes in